And here's what we're going to do, because we do like to we talk more theoretical pros and cons, but we're gonna throw some numbers. And I know most people are probably driving in their car. We're not going to go too deep into them. We are going to create a companion video where we take some time and go through those numbers. But really, Cameron, what would you say the main purpose of a 401k is? What's the end use?
Retirement income.
Okay, I would agree. It's that cash flow in retirement, right? So if that's the main reason why we're doing a 401k, that needs to be the main barometer, right? That's what we need to judge. And so what we did is a little math is on a policy. How much do you need to earn in the 401k each year to provide the same amount of cash flow? Okay. So here's some of the steps that we'd use, and along with the assumptions. We just did 20,000 a year. Okay. Now what we did is 20,000 in the policy, and we did this from 40 until age 70. What we also did, and we did the assumption they were in the 25% tax bracket. What I want to point out to that, to be honest, if you're putting 20 grand a year, you're probably not in the 25% tax bracket. You're probably higher, to be honest. So we are giving them a little more of the benefit of the doubt. But one thing I also, I realized when I was doing this, if you're a business owner, you might be in the 25 or maybe lower, because again, there's a lot of tax deductions business owners can have and that employees can't. Not to rub it in, or I'm going to, but I'm moving literally 150 grand off of my tax return that if I was an employee, I would have to pay taxes on that. And that would have also put me in a larger tax bracket. So really, let's say a third of that would have had to go to the IRS. So that's giving me 50 grand more in cash that I can use. So I need to put it somewhere, so I'm going to put it in the policy. But the bottom line is, if we were to put 20 grand a year into a policy and then cash flow when we're 71, we'd have $94,000 a year. Okay. Now, so the question is, all right, well, the first question is, if we put it in a 401k, what's the withdrawal rate? I'm not talking earnings rate, but if we have a lump sum in there, what percentage can we take out, and with the reasonable assumption we're not going to run out of money? Now, the industry has tried to solve that, and you may have heard of the 4% rule, that you could only take out 4% a year. But then with all this volatility, there's been some people saying 2 or 3. I ended up using 3.5%. Okay. Now, in order to take out, so we need to take out 94,000 a year. And if we want a 3.5%, that means a balance we need to have in our 401k, $2.7 million.
That's it.
Yeah. However, I had to count the taxes. Okay. Because in order to pay the taxes, you can't take out 94. You need 124 to be net with 94. So what that means, in order for those taxes, you don't need to have 2.7 in there. You need to have 3.5 in there. Cameron, how many people do you know that have 3.5 million in their 401k?
I cannot think of one that has anywhere near 3.5.
And I will say, the people that have 3.5 million in their 401k probably they're not relying on their 401k.
Yeah.
Right. They're just using it more as a tax strategy because they have other forms of income. But we also had to take into account fees. 401ks have a lot of fees and a lot of hidden fees. Because even when I was a CFO, we instituted the 401k plan, and it was gonna be like 10 grand a year. Well, I think it was 10 grand the first year, and then there was a smaller amount each year. Like, man, we're a small company. We don't have 10 grand.
Yeah.
You know what they said? Don't worry about it. We're gonna pass it along to all the employees. Those guys paid all of those fees. And I tell you, I looked at the statement; it wasn't clear. It's hidden in there. And then to do some research, I went to unbiased.com, and they gave a range of 0.2 to 5%.
0.2.
I can't. Yeah, 0.2. What I have to assume is they're talking 401k fees, not fees maybe inside of a mutual fund or trading fees. Like there's going to be fees in there. But what we did is I used 2.5%, so somewhere in the half there. So the bottom line is, if you were, and again, we're not putting 20 grand in the 401k. I think we're putting about 26. Right? Because we can put more in the 401k because we get that tax deduction.
Mm-hmm.
Okay. So we're putting, so you need to have in your 401, what you need to earn every single year in your 401k to provide the same amount of tax-free cash or same amount of cash flow, 10.5%.
Oh, wow.
10.5% every single year.
Wow, for 30 years?
For 30 years. Think that's possible?
Piece of cake. No.
What I thought was, so I think what is interesting here, I tell you, to be honest, when I did this, Cameron, I did not compare IBC to 401k.
Mm-hmm.
I compared a high cash value whole life policy to a 401k. Because you had mentioned with all of your advantages, it's not just having that money not tied to the market. It's that you can use that money to create that passive income. You can borrow against it to buy an investment, have that investment repay the policy. So once that's repaid, you have both. You have that asset and your policy continued to grow during the same time. And here's what I think is very interesting, Cameron. What would you say the number one reason people use a 401k for retirement? Like, what do you think their biggest benefit is?
Tax deduction.
Yeah. Tax deduction, right?
Mm-hmm.
I'm saving money in taxes because my CPA said, well, hey, if I put 20 grand in my IRA, I'm going to lower my taxes. And I'd rather put it in my account than pay it to the IRS. Totally get it. I used to tell people the same thing. But here's what's interesting. When we went back and counted the taxes that we had paid, because we had to pay tax on the 20 grand, we ended up paying $200,000 in taxes. Okay. But once you started drawing money in retirement, that money's tax-free. Now, the amount of taxes that you have to pay, because remember, you have to pay 30 grand more, draw that out of your 401k, that 30 grand's going right to the IRS. So you're paying $600,000, which this tax benefit that you believe you're getting, you're paying 3 times as much in taxes. And again, we're pulling out 125 grand a year, and we're told we're going to be in a lower tax bracket. 100% of that 125 is taxable. That's not taking into account Social Security. Hopefully they're going to change that where it's not taxable. But if you have interest, or maybe you're working a job, hopefully you're doing something with your time, or you have some other business or other assets that's only going to add on to your taxable income. And also, that's how your premium, the higher your taxable income is, you pay a surcharge for Medicare, which, I mean, we can go super deep, but the point is, the bottom line is that myth that you're going to be in a lower tax bracket when you retire just ain't so.
Wow. So there's a lot of good information in that. One of the things I wrote down, Anthony, was I want to confirm I'm hearing you right on this one, is that we're comparing IBC versus a 401k. And the number I usually will share with clients is that a policy is going to grow around 4% annually. Mm-hmm. And what I heard you just say there as you got to the bottom of that is that to equal that in income is that policy or a 401k would have to grow at 10.5% every single year
Mhm.
just to equal what's happened in the policy.
Mhm.
That's crazy.
And part of the is because you can have because we don't have that volatility in your policy, we can confidently take out more. So we have a higher withdrawal rate, which means to be ending with the same number, we can have a smaller balance. So even if your policy is growing by 5, your 401k needs to grow double that just to equal it. You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.